not going. Carolyn, are you still there?
I am.
Of course, I'm like, we never have any problems. I just can't tell if everybody can hear me.
It says that the webinar is being recorded on my end.
Okay.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Sorry about that for that little late start. We had some technical difficulties. Allie Peters here, Director of Marketing over at the Core Group. We're so excited today to have Carolyn Burgess-Slavinsky on the line. She is going to go over creating a long-term care strategy that has guarantees included, which is something that we're not really used to hearing much about. So without much further ado, I'm going to pass it over to her. I do want to say real quick housekeeping. If you have a question, please do type it into the question box, and I will make sure to address your questions with Carolyn at the end of her presentation. Take it away, Carolyn.
Good morning, and ladies and gentlemen, thank you for jumping on. I am with Lincoln Financial's MoneyGuard team on the brokerage side. Core Group is one of my largest accounts, and really excited about partnering with Core Group and with you all, and just really bring your long. Is everything okay? It said my entry wasn't valid, Allie.
I can hear you. You're okay.
Okay. All right. So hopefully we'll keep moving forward here. So background real quick, 22 or so years in business. I have been a producer and advisor, specializing in long-term care, working with financial advisors and agents. So really have seen the traditional side of the market, the emergence of the hybrid or the asset-based solutions, the life insurance with the accelerated riders. And I'm going to take this presentation from an agent advisor standpoint. So this is not wholesaler speak. This is really giving you some tips, some sales ideas, some things to consider when you get those dreaded rate increases if you have been a past producer of traditional long-term care, and then talk about some of the other solutions that are out in the market. I'll give a little plug at the end for MoneyGuard and my contact information and some of the tools that I'll go over. I'll have Allie send out to you all as a follow-up. But really, I just want to help you manage those client relationships. When you do get a rate increase letter, or your client who has purchased long-term care from somebody else gets a rate increase and calls you in a panic. Agenda, we're going to talk about the need on a very high level. This is the most exciting time of my career, where advisors and agents, I used to call it agent avoidance or advisor avoidance, where having the long-term care discussion was last on the priority list. Clients were bulletproof, didn't want to have the conversation. That is all changing with baby boomers. They're still bulletproof mentally, but they're seeing it with their parents. So the need is becoming, the awareness for the need to at least have the conversations becoming greater. We're going to look at the long-term care spectrum, talk about standalone long-term care planning versus using a linked benefit or an asset-based plan. We'll talk about the life insurance opportunities that are out there that have accelerated benefits for chronic illness, critical illness, and long-term care. And a little feature comparison. We're not going to get too far in the weeds there, but please make sure you ask questions if you're thinking about it. I'm sure your colleagues who are on the line have similar thoughts, and I'd love to address any of the concerns that you have. Grab a piece of paper and a pencil. I'll give you some power phrases to help you through these conversations. And again, I appreciate you being here. All right, so the need, basically 12,000 baby boomers are turning 70 every day for the next 16 years. By 2030, 1 in 5 Americans will be 65 or older. I'm not a huge stats person. It never does any good to sit down with a client and say 1 in 5 Americans will be 65 or older. Age is relative. Younger is 10 years younger, older is 10 years older, and we seem to stay in place and not age, right? The reality is 75% of caregivers are women, so this is a women's topic. This is not a women's presentation, so I'm not going to go into the specifics there. It's just kind of creating that awareness. Women are a great target market for you. not just widows and single women or divorcees. All women are a great place to start planting that seed. If you're having a conversation, husband may not be there. Starting to educate them, even away from their husband, gives you an opportunity to sit down maybe with a warmer, open dialogue with the couple. People with disabilities, over the age of 65, there's a 70% chance that you're going to need some kind of long-term care services. 1 out of 2 people will need long-term care services in their lifetime. However, I've heard it's 2 out of 3 women. Like I said at the beginning, statistics really aren't what sells long-term care. It's taking it back from a psychological standpoint to creating a protection plan for their family, for their loved ones. Long-term care planning is about taking care of the people they love most and who are going to take care of them. So paraphrases on this end, stay away from stats. My recommendation, don't use the word nursing home. Talk about this is anti-nursing home planning. And the questions that I would encourage you to ask to open up the dialogue are, what's your plan if you had an extended healthcare event? So what's your plan if you had an extended healthcare event, and how are you going to fund it? Oh, why isn't this going? There we go. All right, so biological reasons. At age 65, women have a life expectancy of 23 years beyond the age 65. We've got biological reasons, gender-based reasons. I always tease and say we take care of our husbands and our loved ones so well that we put ourselves into a nursing home. Statistically, there's more women in facilities than there are men. And here, this is my favorite slide. And I don't know why my PowerPoint presentation is acting up, so forgive me. Well, it is my favorite slide because it's a rainbow and it's colorful. But right here, it talks about the different kinds of funding options available with long-term care. So the orange spectrum, what it would say is self-insuring or self-funding. When clients say, I'm going to self-insure, no, they're not. They're going to self-fund. And so your number one way to overcome any objection that your client brings to you is use the word absolutely. My children are going to take care of me. Absolutely. The government's going to take care of me. Absolutely. Let me show you what you need to do to qualify. My kids, absolutely. Your kids are going to do their very best job. Let's give them the tools to manage your care versus provide your care. So right here in the orange, and I can't see it on my end, so I'm assuming you can't either. This is self-funding. Then we move into the accelerated benefits. This is the hybrid spectrum, where we're going to talk about the life insurance with accelerated riders. We're going to talk about asset-based features. There's annuities out there that are, some really wonderful annuities that I for the right clients, older clients typically that have old annuities sitting out there, I think they're great solutions. And then over here in the darker blue section is traditional long-term care. So since this slide is aggravating me a little bit, we are going to move into a slide that is seeming to work. But knowing the options available, standalone long-term care, if you think about the typical objections that you get when you're going through a presentation that shuts down the conversation, are the use it or lose it. What if I pay into it for all these years and never use it? I don't get anything out of it. We have the standard canned industry dialogue of, well, you don't question paying into your homeowners. Really, from a tangible standpoint, insurance, we run into insurance being a dirty word to a lot of people. And what I would suggest here is to talk about insurance as income. So you're creating an income source that keeps them from having to make 26% returns or 19% return year after year after year in the market to create the same tax efficiency for long-term care planning. Now, the dreaded rate increase conversation starting in about 2012, and I've written hundreds upon hundreds of traditional long-term care policies, and I have had the same phone number for 22 years. So every time there is a rate increase, and I wrote primarily New York Life policies, as well as Genworth was a carrier that I relied on pretty significantly, some Hancock, but every time there's a rate increase, I live in Texas, it's filed and approved, which cumulatively, Genworth is facing, I think it's right over 200% of long-term care. I get a flurry of phone calls from either agents that I worked with as their specialist or the clients that had my business card from way back then, same phone number, and they're ready to jump off the ledge. They're frustrated. They're angry. And, you know, really it's a time to kind of help them. If you know about the rate increase, my first tip to you is to give them a call. Now, I'm going to give you guys a heads up if you haven't seen it already. Northwestern Mutual is having a rate increase, and it's spread out over 2 years. It is fairly significant. So if you have clients with Northwestern policies, you know, get on the horn, let them know. The other reason for getting ahead of it is there's going to be a letter that comes out with your annual renewal statement that tells them how much their premium is going to go up this year and then how much their premium is going to go up next year. Now, getting ahead of it and just saying, you know, you've been made aware in the industry, whether you wrote the contract or not, and it's a good time for you guys to sit down and do a third-party designee update as well as review the contract to see if there's anything else in the market that's emerged that may either supplement or serve them better. Now, the huge heartache that clients have is, well, I paid into it for the last 20 years and now I'm just going to drop it. I never encourage anybody to just drop their contract. You know, the things that got the industry into trouble in the beginning, the product model that was put together 40 years ago was modeled after disability insurance. You know, almost every carrier, if not every carrier, were offering unlimited benefits, 5% compounds, and they had a lapse rate of over 10% factored into the original model. The actual lapse rate is under 1% industry-wide. When there are rate increases, there is a bigger dip, but people don't drop the contract. You know, they make the commitment to the premium, they make the commitment to having a long-term care plan. So when they call in, ask for a copy. If they call you, ask for a copy of the letter with the rate increase options. Make sure you read over it. Rely on one of us. Lincoln, we have an amazing competitive services desk that will do a policy review for you. You can give me a call, shoot me an email with a copy of the policy. I'll do the review for you. But there's a very important feature in many of the contracts that were written in the last 20 years that's consumer protection, and it's the contingent non-forfeiture benefit. That is what a lot of the State Department of Insurance required be inside the contract that say if your premium cumulatively at any point in time goes up a certain percentage based on the age that you were when you took out the contract, you'll be able to stop paying premiums. You won't give any back, but you can stop paying premiums, and you'll have, it's a formula, every contract's a little different, but you'll have a bucket of long-term care money based on the premiums that you paid in. There's usually a window to accept this. So that's why I'm saying if you know there's one coming, you know your client has, say, a Northwestern, I think Genworth just filed for another rate increase, you know that they have this option, get in front of it and say, you know, let's take a look when the letter comes in and see if maybe we want to either reduce the benefits, maybe you go from an unlimited to a 5-year plan or a 6-year plan, or you go from a 5% compound to a 3% compound. The reason I am really encouraging you, please if you're not comfortable, let a specialist help you review the policy and the declaration page. And the reason why is there are some carriers out there in older contracts that if you drop your inflation protection, so you drop it from 5%, they're now 80 years old, it's grown from a $100 daily benefit to a $300 daily benefit, you drop the 5%, there are some contracts that have language written inside of them that you lose everything you've accumulated from the time that you took out the contract to dropping the inflation. I hate bait and switch. I think it's shady, but just making sure the recommendation fits and stays in line with whatever the client has in benefits, that we're still going to be able to serve their needs. But just, you know, my grandfather was my first long-term care policy that I wrote in 1997, and he had 5 rate increases, and the letters came every November, right before Thanksgiving. So Thanksgiving, about every 3 years, was pretty terrible. Just convincing him he has MS, we cannot go and get, coverage anywhere else. You know, his policy started out at about $1,100, I think, when I originally wrote it. and was over $6,000 by the time he went on claim. The reality is he was on claim for 9 years, get unlimited benefit. 9 years, $650,000 later, the policy paid, and it worked exactly how it was supposed to work. But convincing him, man who's frugal, living on, I wouldn't say fixed income, he put himself on fixed income, really wasn't wanting to factor in a couple $1,000s extra for this policy he didn't know whether or not he was going to use. So just make sure you're an advocate for your client. You know, a lot of them are going to say, well, I thought the premiums were never going to go up if they haven't seen a rate increase, especially some of what I call the big box carriers, the mutual companies. I honestly didn't think Northwestern would ever have a rate increase. I was hoping that there would be one company that held out, but the reality is how things were designed 40 years ago, we've had that evolution, that rate increases are happening, have happened. I'm going to now go into some sales ideas, some concepts that maybe you can do some blending when you're doing the review of their current contracts. I rewrote a 70-year-old woman last year. Just for full disclosure, I work for Lincoln MoneyGuard now. I worked for One America on the direct team up until December of last year. And so I'm comfortable with all of the asset-based products. I also was the insurance specialist for an RIA, doing all insurance for 15 wealth advisors while my kids were in diapers and airplanes didn't take triple strollers. So I really do understand kind of what you're faced with when it comes to the emotions that clients have, but just getting in front of them, doing a full review, advocating for them, get on the phone with the insurance carrier before you make any kind of recommendation. Your client will need to be on the phone and they will need to give you permission to speak with the rep. However, that way you can ask those questions like, how is this going to impact if we drop the inflation from 5% to 0? Or do they lose all the accumulated benefits? How does the multiplier work if you go from unlimited to a 5-year plan? And or maybe look at making some changes or exercising the contingent non-forfeiture benefit, having that bucket of money on the side and looking at some of the options like a linked benefit or an asset-based long-term care or a life insurance with an accelerated rider. So standalone, the client profile, there is still a market for traditional long-term care. Obviously, I think it was the wild, wild west when I started writing. I think there was over 100 companies offering some form of long-term care, traditional long-term care. Now there's maybe 6. Probably 4 that I'd say I'm really, really comfortable putting anybody with. But, you know, we really don't have the options that we used to have. And the ones that have stayed in the game, I think, are pretty committed to staying inside the market. There's a recent article Barron's had just published, I think it was on the 6th. I'll send it to Allie, the link, so you can take a look at it. And it's a fantastic article. It talks about the decline in the traditional market. There still is that market for somebody who doesn't care about the life insurance component. He wants the lower initial premiums, is inflation sensitive. There is a lower annual cost, but honestly, if you lay traditional up against a lot of the hybrid or the asset-based solutions, the life insurance, the accelerated benefits, with today's premiums and rates and underwriting, a lot of times you're going to be within shooting distance of being able to be in line with the premiums on the hybrid solutions. Partnership qualified, for those of you, I'm sure you've had to take a partnership class, but partnership qualified or state specific, that gives them some asset protection. I have heard with the new generation of price-based reserve changes on new contracts, there's some evolution happening where some of the hybrids are looking at partnership options. So, you know, I think that there's going to be a continual progression towards the hybrid space. So I'm encouraging you to really get a handle on which options are out there and what they actually mean. Things to consider on the traditional: premiums are not guaranteed. Clients may never use the coverage. It's a use it or lose it proposition. And then there's no cash value inside of it. Essentially, you write your check January 1st and you've got coverage to the next January 1st. You don't use it in the next 365 days. There's typically no recovery. Some policies will have like return of premium if you die before the age of 65. That doesn't go back to you when you're living. It's going to go back to your estate. Linked benefits. I prefer to use asset-based long-term care as how I define it to clients. I talk about this as we're reallocating money from your left pocket to your right pocket. And instead of it being a $100 bill in your left pocket, it's now 500, 600, a million, whatever the number is in your right pocket, and it's coming out on a tax-efficient basis. The biggest objections you're going to get here is I don't need any more life insurance. This is not a life insurance play. This is for somebody who is looking for guarantees. Guarantees that the rates are not going to go up. Guarantees that they're going to get their money back in some shape, way, or form. It's going to come back as a death benefit. It's going to come back as a tax-free long-term care benefit, or it's going to come back as a return of premium. Lincoln specifically, we offer 100% on a 5-year vesting schedule, or we offer 80%. My plug for my personal preference as an advisor, as an agent, more long-term care benefit, do not worry about the return of premium. Less than 2% of all linked or asset-based contracts ever exercise the return of premium, and the majority that do pull it out in the first 365 days because of buyer's remorse. So this isn't a safe money play, this is a long-term care play. Clients that are sitting down with you and realistically talking about shifting $100,000 or $7,000 a year or whatever number it is to get to the right formula of benefits, they are looking at it from a long-term care aspect first. I get my money back if I never use it, which is we don't have crystal balls, we have no idea, and God has a sense of humor. So it's coming back, and it's usually magnified over what they put into it. Or third, if an emergency comes up, they can take a loan or use the return of premium. If a client is more worried about the return of premium, I would suggest not putting as much money into the contract, put that into their checking account, and then use the rest to write a policy. Benefits, the typical benefits that you're going to see, the return of premium, available inflation protection. MoneyGuard has an outstanding inflation protection option. Is at 3% on the entire contract. So your 3% compound benefit is growing every single year, even when you're on claim. Death benefit availability, guaranteed premiums. At Lincoln, we are built on a UL chassis, but there's a rider, I'm not going to go into the mechanics here, that's built into it to guarantee your premiums are going to stay the same unless somebody doesn't make their premium payments. Then it kind of changes everything. We'd have to run an enforced illustration. Guaranteed long-term care benefits. As long as your premiums are paid or you paid your lump sum, your benefits are guaranteed at wherever you start, plus whatever inflation protection that you've put on it, as I mentioned, continues to grow as you are receiving benefits. We do have a flex pay. I have been trying to convince there's two things, I crack myself up sometimes, but there's two things I've been trying to convince my boss and my marketing team to create, so I'm just going to give you a visual here. I would love to send out a postcard to everybody with like Abe Lincoln flexing his muscles saying, want to see me flex? So many of the advisors that I meet with don't realize that we have flexible premium payment options. You can do a 7-pay, you can do a 3-pay, you can do 10-pay. If you do, it has to be paid up by 65 currently. Just to put you guys on notice, we are going to be launching our MoneyGuard 3 contract. I haven't seen benefits or changes yet, but estimated date for that is September 1st. So if you've got old illustrations out there, make sure you rerun them. If you have been looking at other carriers, please give us a chance to compete. So we do have single short pay options. If you're 45 taking it out, you'd have 20 years to pay it. So if you do longer than a 10-pay, it needs to be paid up by the age of 65. Life insurance with a rider. And here I want to be very cautious with y'all's time today, or considerate, I guess I should say, but life insurance with a rider. So I can get a little feisty when it comes to this, and this is why. I had a wholesaler sit in front of me when I was an advisor, and it was just when the accelerated benefits on chronic and critical illness rider. I had a wholesaler sit in front of me and flat out tell me this was a long-term care contract. I was in the business long enough, I should have known better, so it's a shame on me. However, I think my responsibility now as your external and your wholesaler is to make sure I give you facts, right? Make sure I give you the information so you look like an expert, or I am your expert on your team that you can bring in. And I sold 5 contracts that were chronic illness riders, thinking they were long-term care. 4 were in underwriting. 1 was issued. The sweet woman's name was Celeste, and she comes in with a $13,000 annual premium. So not a little penny. And she comes in with her contract highlighted in sticky tabs. She sets it down and she said, "This is not a 7702B. And I said, "What?" She said, "This is not a 7702B. And I said, "No, it's a long-term care contract." She said, "No, it's a 101G. So that was my client educating me. I will tell you, I was never so humiliated, or at least this is one of the few times I was super humiliated. And it caused me to really dig in and do some investigation on what's the difference between chronic illness and critical illness. So chronic illness, critical illness are not full long-term care contracts. They have similar definitions. They have similar triggers, like you need help with 2 of your activities of daily living with the expectation that it's going to last 90 days, or you have severe cognitive impairment. So that diagnosis still has to happen. The recertification once a year still has to happen. However, it has to be a diagnosis that either you're not going to recover from, so chronic, and as much as we'd like to think that aging is a chronic disease or illness, it's not. So if you're just aging in place, need help getting in the shower, need help getting dressed without falling over, but everything else you're perfectly functional, under a 7702B, you would qualify for benefits if it was expected to last more than 90 days. If it's not a diagnosed chronic illness like Alzheimer's, dementia, Parkinson's, MS, that is creating your need for care, then the chronic illness rider is not going to trigger. There's also a difference between stand, and here's the knowing the difference slide, of course. There's a difference between standby and substantial assistance. So standby assistance means that you don't physically have to dress that person or physically have to bathe the person, that you're standing by to keep them safe. Substantial or hands-on assistance means that you have to feed them, you have to bathe them, you have to dress them. So really taking some time and looking at those definitions. Critical illness means that it is a short-term-ish, potentially could be longer, but a diagnosis of stage 4 terminal illness, let's say cancer. Those are the things that are going to trigger the critical illness. Maybe an accident. Somebody was burned over 90% of their body. That's a critical situation. A chronic is going to be a lifelong diagnosis. Whereas long-term care is going to cover you, whether it's you fell and you broke a hip, and maybe you won't be better for 6 months, or like I said, you're just aging in place. You're just needing some help because your 85-year-old body isn't working like it did when it was 65. So really understand it. If you look at an illustration and it doesn't say long-term care anywhere on the illustration, it is going to be a critical illness or a chronic illness. Typically, the chronic illness is going to be a cash benefit. And I'm going to try and close this without messing up here. But the tax code for 101G, it's got a defined benefit, is based on the death benefit, cash surrender value, and benefit amount requested. Now, the other thing that you need to be focused on when it comes to chronic illness or critical illness, it depends when you file a claim. So if you sell this to a younger person with a chronic illness or critical illness and they're diagnosed with something at, say, 55 years old versus 85 years old, there may be a reduction in the death benefit, so they're not going to be able to pull as much out. A tax code 7702B, which traditional long-term care, or what you see on Lincoln Money Guard, Asset Care with One America, Care Matters Nationwide, when you look at those are going to be 7702B. They have a defined benefit duration, can be a temporary or permanent condition, and could be reimbursement and or indemnity. Real quick, I'm going to go into the differences on indemnity on a really high level. I don't want to get in a debate about it, but I am a fan of reimbursement. I have a story that I will share with you guys another day when we have a little bit more time. But essentially, I like reimbursement professionally when I'm working with clients because I know that the funds are going to go for qualified care. Most of the clients that I sit down with when I'm asking them, what's your plan? How are you going to fund it? And they give me whatever their plan is. My kids are going to take care of me. Not very often does it come up. It's usually an objection first, but when we start talking about it, they don't want their kids to take care of them. That's the whole reason they're looking at long-term care in the first place. So why would we put a plan together that creates a cash bucket with no accountability? If a client says, I want lifetime benefits and I want a reimbursement plan, or I want some indemnity, I want some reimbursement, not to overcomplicate the sale, give them both. Split the ticket. Put some with an indemnity contract, some of it with one that's a reimbursement. So at least a portion of it is going to go for care. This is a lot on one slide, so forgive me. We're not going to go into every one of these, but the linked benefit options and the life insurance options are surging in this market. And the reason for that is because all of the objections that we have in the standalone plans are typically overcome by the hybrid options. The linked benefit, asset-based, you'll hear it called everything. People are self-insuring better. So when somebody says, I'm going to self-insure, no, if you choose to pay for it out of pocket, you're going to self-fund. Or I shouldn't have said no. Absolutely, you can self-fund. Let me show you how to do it better. And power phrase there, absolutely, you can self-fund. Let me show you how to do it better. So using the linked benefits, they know that the money that they put into their contract is coming back to them. It kind of gets past that Superman syndrome that we face, that it's never going to happen to me. None of us really know. So just giving them that empowering them. I don't know if it's going to happen to you. We are going to reallocate some of your dollars and just make sure that we have this tax-free bucket of money. And if you're right and I'm wrong, it's going to go back to your beneficiaries tax-free. The options available, we've talked about standalone, we've talked about linked benefit, we've talked about life insurance with riders. None of them are wrong. The fact that your clients are having a discussion and putting a funding source in place is great. We now have a new piece that I'll also send to Allie to send out. You may have seen it the last time, I think on our last conference call. It's called the Asset Identifier. I like to call it my Columbo approach. Some of my colleagues actually use it from the very beginning of let's identify the assets you're going to use to pay for care. I like to use it as a piece that when they've given me all of their objections and they say they're going to self-fund, absolutely, I'm perfectly comfortable with that as your financial advisor, as your agent. I have a fiduciary responsibility to identify the assets that you're going to use to pay for care if something were to happen. I've got it in PDF. You can change the logo on it if you want to put your company logo, your information. It has a place for you to sign. It has a place for them to sign. You stick it in the file. Every time you do a beneficiary update or a client review, pull it back out and say, I just want to make sure that nothing's changed here. I think it really communicates the seriousness of you wanting to make sure that you've identified that assets and that you have a well-documented plan in place that's going to help them pay for care. So questions, I like to keep it simple. 2 questions. What's your plan? How are we going to fund it? Asking the right questions, open-ended, really getting an idea of what they think long-term care is. As I mentioned at the beginning, this is not about changing kids chasing, mom and dad's diapers. It is not about nursing homes. The goal is to create a place or a plan to allow them to age in place. One that's going to make their dollars for retirement last longer, allow them to be more aggressive or go enjoy life a little bit more now because they're not worried about accumulating a bucket of money to pay for care if they need it. Payouts. I'm going to go from here into a form. So what I talked about indemnity, and we're right at 12:35. So I'm going to kind of reel it in here. But indemnity for me is not bad. But what I hate to hear on a platform is, mom and dad can take the whole family on vacation. Yes, they can do that. Indemnity gives the family a bucket of money depending on how the contract is written. Each contract's a little different. So just like with a life insurance with the accelerated riders for chronic and critical illness, understand how your indemnity plan works that you're presenting to your client. Is it going to be a bucket of cash? Is it going to be a monthly amount that shows up? Can you ask for less? How is it going to be taxed? You know, everybody thinks, well, it's just this check that's going to show up in the mail and mom and dad can use it for however they want. The reality is there is still an audit trail that is required. So if you go and you Google IRS Form 8853, and I'm actually going to pull it up here. I've got it up on my computer. Just so you can see it. So 8853 is the form every year that can be received as benefits. They're going to get a 1099 LTC. This form is a 7-page form because the government can't simplify anything. The first part is based on MSAs, but if you move down to page, I think it's 4, that's where we get into the long-term care worksheet. There is a requirement for declaring where those dollars went. So if you took your $6,000, your $10,000 a month, and you decided to go on a cruise with the entire family, that is not considered a tax-qualified long-term care legitimate expense. So you have to go through this wonderful flow chart, looking at the per diem payments, talking about who received. You start here. If it's a yes, if it's a no, I am not going to take you through the flow chart. You can take a look online. If you'd like, you can find it on irs.gov. But it is 8853. You get down to going through the worksheet, and then it tells you person to receive per diem payment. So if you have a child that is receiving money from you because they provided you qualified care, they must report this as income. So indemnity sounds great in a simple presentation, but really understanding somebody is still going to have to manage where that money went. You know, did it pay for kids' college? Did it pay for new tires on kids' Suburban? Or did it make sure that mom and dad had a quality caregiver coming in to take care of them? I am not saying that all families are like that, so please don't think I'm generalizing, but just really understand what indemnity means and how the benefits are going to be paid out, and that there is still an audit trail. Versus over at Lincoln, we have a claims concierge system in the Silver Brick Road that will pay the facilities directly, taking that audit need out. Now, you're still going to have to fill out the 8853, but it's a reimbursement plan. So most of the lines that you would have to go through for an indemnity plan versus what you're going to have to fill out for a reimbursement plan are negated. So with that, I'm just going to pop open the asset identifier, show you guys what it looks like, and we are going to be done. I'm happy to take questions. Dan Smith is S-M-Y-T-H. He's at daniel.smith@lfd.com, or you can reach out to me directly. We're here to help. You know, love working with you guys, but this piece is my favorite all time, simple. The financial process, we just kind of go through the costs in your area. You can pull it up on our site, what care costs. The sponsored login is Lincoln. And then here, when you're going through and saying, okay, if you don't want to put a plan in place and you choose to self-fund, what are we going to use to pay for your care if something were to happen? And you can outline the accounts. This is also going to help you not only identify the assets, it's going to help you uncover other assets and funding sources. Maybe they do have a whole life policy that they bought 50 years ago that needs to be reviewed, and maybe it could be the funding source for an asset-based solution. So it's a great piece for you just to have on file. Keeps you covered from a legality standpoint, and conveys that it's a very serious conversation that you're having with them, and that it is part of a holistic and comprehensive wealth plan. Signatures in the file, take a look at it once a year, life changes. So with that, Allie, I am going to take any questions that participants may have, and again, I thank you for your time.
You are so wonderful. Thank you, Carolyn. I don't see any questions in here. What I would just tell everybody is that some of the documents that Carolyn has showed us today, I will make sure that I have a copy of those attached along with the recording of the webinar, which will be sent out to all attendees and people who actually missed out but signed up. They will get that as well, and all of the links will be below the webinar replay. So so you can share it, if you can watch it again, if you have something that you need clarification on. I would take Carolyn up on her offer, or if you want to reach out to your relationship manager to do a a look through on any policies that your clients have now. We're always first to say if it's a good policy, we'll let them know, right, Carolyn?
Absolutely.
So just make sure that you're doing all that due diligence, and if you're having any stumbling blocks on having the conversation, Carolyn is so good at it, and she really knows what she's doing. So please do feel free to reach out. And with that, I think we'll probably wrap up, and we appreciate you doing this for us today, Carolyn. Thank you so much.
Yeah, absolutely. Y'all have a great rest of the day and week, and I hope to be in contact with you soon.
All right. Thanks, Carolyn. Have a great day, everybody.
Right. You too. Thanks. Bye-bye.